Infosys also 5% lower. So a lot of pre-trades coming in right now in pre-open. So we'll wait for that to settle a bit. Let's talk about the rupee opening, which has opened quite weak actually, 49.38. Globally, you've seen a bit of a rally in dollars. So that could be a factor playing out right now on the dollar rupee. But the Nifty as of now is still at 53.55. DLF is up 1%, Tata Power is up 1%, and Coal India up 1%. So these are some of the stocks that stand out on the way up, but still a couple of free trades. So the Nifty is still not arriving at its logical rate.
ONGC is showing a downtick about 4.5%. That should, as Anuj is saying, correct itself, but it's maintained that for the last few minutes that pre-open has seen. Remember, there is a news piece indicating that the government is going to aggressively try and go in for that 5% auction for ONGC. They're indicating that this could be the right time to go ahead and divest as well. HDFC now showing a free trade about 6.5%. So unlike yesterday, it's all over the place. Check on what Wipro is doing as well. Remember, surprisingly, it was the weakest counter on the Nifty yesterday. That's after a Goldman report came out and downgraded the stock and said that they will underperform its peers. That stock is down about 0.5% right now. Tata Power recuperating some of those losses of yesterday. Coal India, after a set of numbers that the market has applauded, is up 1% again in trade today. RCOM under a little bit of pressure. News reports during the rounds this morning that are not positive for the company. Stocks down 1% right now. Tata Steel definitely under pressure. Let's check on what Tata Motors is doing as well. They come out with numbers later today, possibly in the last hour of trade. It's up about 0.5% as well. So a lot of stocks. Cipla should be another one that should come up. Numbers were disappointing. The street delay coming in as well. There, Cipla down about 0.5%. So no big moves, Anuj, but that was largely expected as well.
Yes, indeed. So these are some of the stocks that will react. In fact, let's also talk about the top 10 stocks that we believe this morning are going to be the most active ones. Let's start with Cipla at number 10. That stock will react to results that miss market estimates announced after market hours. The profit though rose about 16% to 270 crores. It was higher on lower raw material costs. The top line disappointed as well, rising only 14%.
Take a check on the OMC major IOC as well. A 14% rise in net profits is the first profit that they have reported in over 3 quarters.
Aurobindo Pharma has posted a 28 crore loss for the third quarter against a 180 crore profit in the same quarter last year. The company also saw IT raids being conducted at its offices over the weekend.
Take a check on Lanco as well. Have an earnings impact as well, but other news reports are also indicating that they might exit their wind energy projects, and they have hired E&Y as the buyer.
Keep an eye on the SBI stock again then. Most brokerages have given a thumbs up to the number. CLSA has increased its price target to the stock, to 2090 from 1640, and Deutsche Bank has increased price target to 2400.
And Saskin may see a buyback boost coming in. BSE release indicates the board meet later this week on 16th to consider the buyback proposal.
Reliance Infra, stock which rallied big time yesterday, that Q3 profit is expected to double to 385 crores on higher margins, which are expected to jump to 12.7% from 4.6%.
And Tata Motors, yet again a number that you need to watch out for, especially in the last hour of trade. Favorable currency movements as well as good GLR numbers should prove profit up 12% in the quarter gone by.
And number 2 on our list is Sri Renuka Sugars. That has reported a 400% jump in net profit to 34 crores. Last quarter, of course, it reacted so sharply to its earnings. So this time, the reaction would be equally interesting.
Another mid-cap to keep an eye on this morning. Punj Lloyd, a jump in other income has helped Punj Lloyd post a profit of 70 crores in the quarter. The company continues to reel under high debt with margins, however, under pressure. EBITDA is down to 79% year on year.
Mehrpoon, any of these stocks that you would comment on? Sri Renuka, Punj Lloyd, some of the stocks where balance sheet is an issue, and but the stocks have fallen about 70-80% from peak. Any kind of opportunity in these stocks?
I think if I had to take an exposure to sugar, I think Anuj, I would take it to Sri Renuka. I think it's the best bet according to me in the entire pack. And the other company which you mentioned, I think would possibly be Tata Motors. I think this is a company whose results I'll be looking out for, because to an earlier question I'd already said this is the best bet according to me in the automobile pack, especially the four-wheeler. I think I'll be looking at the numbers, and yes, the foreign exchange thing could be a major boost for this company as far as profitability goes, which the market possibly may end up ignoring. But ultimately what is important is to see the overall performance of the company. So these two are the things which I would possibly be looking out for.
Sailesh, how is Cipla looking?
we've seen some good build-ups in the last expiry, and a lot of these build-ups have got rolled over to the new expiry. But in the new expiry, it hasn't done much. Probably the build-up still remains. It's not seen some aggressive long build-ups nor any short build-ups, I guess. One can look at the stock if it corrects probably close to 334, 335. I guess that's the level last time around. We saw some good long build-ups. I guess this stock needs to correct probably to draw some long build-up interest.
Saumil, what would you do with an RCOM at these levels at 92?
RCOM is a good buy right now, and I think it has retraced 38% in last couple of weeks, and I'll be expecting the stock to again start moving up. The momentum indicators are in the buy side. It has formed a small triangular pattern on the hourly charts, and I'll be expecting this stock to reach at least break at least the previous swing high and at least give us gains of 10 to 12% in the short term. In the medium term, it has formed a very huge ending diagonal pattern which has been forming from I think November, from last 3 or 4 months, and it has broken on the upside. The momentum indicators are the buy side on the weekly charts and the monthly charts. So I think one should go ahead and buy this stock. I'll be expecting RCOM to go at least till 130, 140 levels.
All right, the last bit of pre-open is taking place, the last minute of pre-open. In fact, the pre-open has now ended down about 0.2% at 53.80, absolutely flat. Cipla, on back of those disappointing numbers, ended down about 2%. And ADAG stocks, a couple of them did well. Reliance Power, which was up about 1% or so. So these were a couple of stocks active in trade. What was interesting in pre-open was that some of the stocks which came out with the numbers in yesterday didn't really react too much. So Coal India actually ended pre-open absolutely flat, and even SAIL actually ended down about 1%. So that is now the likely trend, a bit of an underperformance maybe from SAIL going forward. Let's take a break on that note. Once we come back, we'll have the actual market opening as well.
First Trades, presented by BSE, Investors Protection Fund.
Presented by BSE Investors Protection Fund in association with Samsung Galaxy Note and Birla Sun Life Insurance, Wealth with Protection Solutions.
India's #1, world's #5 commodity futures exchange. Hedge your risk on MCX. MCX, trade with trust.
आज क्या बात है?
आनंद।
बड़े खुश लग रहे हो।
परम आनंद।
कुछ बताओगे भी?
निर्मल आनंद।
LIC जीवन आनंद, मैच्योरिटी पर सम एश्योर्ड और बोनस, उसके बाद भी जीवन भर इंश्योरेंस का भरोसा।
मिली वो? हम, तुम और वो तो आनंद ही आनंद।
India's #1, world's #5 commodity futures exchange. Hedge your risk on MCX. MCX, trade with trust.
First Trades, presented by BSE, Investors Protection Fund.
All right, markets will open in next 5 minutes. The pre-open ended absolutely flat. The SGX2 is indicating to a bit of a flat start. So really it's going to be that kind of a market. Mehrbun, let's talk about IT, because that was one sector which led some part of the rally and then again has taken a bit of a backseat. What's your call on this one now? Because last quarter was good for them in terms of what happened to rupee, and this quarter some of that will get reversed because of the kind of rally that we have seen in the currency as well.
I think I would like to stick to the frontliners, I think, and I think my top bet would remain Infosys and TCS. Maybe in that order. A close second would be TCS, only because the consensus prefers TCS right now. Point one. But I honestly am going to look out for the developments in the US. I think we need to understand US is going for elections. So we'll have a lot of noises coming over as far as the business goes. I think it's already starting to come out. So, plus Infosys has got a battle over there as far as the visa problem goes. So one will really need to watch out for. But what is admirable is the fact that the numbers honestly were not disappointing by any standard. As far I'm talking on the front line, Infosys and TCS. Point two is they have performed remarkably well, I would say, in a bad environment. And if we are looking out for things to ultimately improve in Europe, though at a very muted pace, and US honestly is coming out with more positive surprises of what most of us had expected some months ago, I think data coming from US is encouraging. I think you can expect these companies to continue to fare well. I think the foreign exchange play which they had in the last quarter would possibly not continue because rupee has appreciated now. But at the end of it all, looking at the way these managements have performed, looking at the way they have come out with their guidance and normally stuck to them, maybe Infosys has disappointed in the last 2 quarters. But on the whole, I think you need to have one frontline IT stock in your portfolio while continuing to watch the developments in the US because ultimately that could possibly have an impact on this frontline IT stocks, especially with US going into elections.
Mehraboon, we talked about a lot of the mid-cap, especially in the sugar space. We didn't discuss fertilizer, another pack that saw a big rally up. Are any of these rallies believable, or are they just these sort of mini pre-budget rallies that we keep seeing that shouldn't be bought into at all?
I think fertilizer ultimately could end up being an interesting play, but on the whole, I think I will agree with your remark. I think a lot of times stories get floated and people suddenly forget the negatives and start becoming optimistic. And the only big worry, according to me, for the market is I think the consensus largely now feels that the worst is behind us. And I think possibly that could be the reason for quite a few mid-cap stocks also going up sharply and people expecting things to largely improve. We need to understand that the things are difficult for the government. One should not be expecting too many things. At the end of it all, what is important is what will happen as far as fiscal consolidation goes, as far as will there be any measures post-elections in the states on the reforms front. Other than that, I don't think any sector should be expecting too many lollipops to come their way.
Mehraboon, let's talk about consumption theme because you are bullish on some of them. But the numbers this time around had a bit of a reality check. Say in a stock like Lovable, which fell 10% after that. Would you still remain bullish in some of these consumption themes?
I suppose so, yes, Anuj. I think we need to understand the size of the balance sheet over the next 2, 3, 4 years. I think they don't have those sectoral problems. I think India ultimately is going to remain a good story as far as consumption goes. And while you mentioned Lovable Lingerie, I think there are other names also like a Jubilant Foodworks, which surprised with the positive, the stock went up. There are stocks like a Delta Corp, which I think I continue to remain positive on. So I think even a Dish TV, I think the business is just going to keep on growing according to me. There will be mishaps here and there. I'm not saying no, and every stock in the consumption story need not be bought into. But I personally like the story. I think India should remain a country where consumption will ultimately help our country progress.
All right, Mehraboon, thanks a lot for coming in and taking us through market opening. That's the view from Mehraboon Irani. He still remains bullish on some of the consumption themes. Jubilant Foodworks and Delta Corp in particular are 2 stocks where he's bullish on. And in the large cap space, Sun Pharma is a stock that he'll be watching out for. And Sun Pharma as a stock has become one of the best pharma plays, one of the largest pharma companies now. So that's another stock that's on Mehraboon's radar. The pre-open, by the way, ended with about 0.2% cut. So expect a bit of a flat opening this Tuesday morning, and then we take it from there. The stocks on our radar would still be SPI and SAIL in large caps, and Sri Renuka and Punj Lloyd in the mid-cap space.
In fact,
There are now 10 seconds for the opening bell. Today's opening bell is brought to you by Tag Heuer.
Alright, so the opening rates are now coming in. The Nifty opens at 53.80 in line with what the pre-open was indicating. Cipla is your top loser, as you would expect, 2% down on Cipla. ICICI is down about 0.5%. So these are 2 stocks which have tracked the markets a bit. IDFC, which has become a bit of a weak stock again, is down about 1%. Apart from that, you have Relcom actually going down in trade today, 1% lower on Relcom. Now, what's interesting is this news bit coming in on tar companies and TRAI actually wanting the FDI limit to be cut from 100%. And when we spoke to the Relcom management yesterday, they did say that a deal for tar company is almost through. We don't know if the market is getting a bit nervous about that deal again going forward. That's an important news pointer. Cipla down about 2.5%, easily your stock of the day or earnings reaction of the day in the large cap space. ONGC is down about 0.5%. SAIL is down about 0.7%, Reliance is down about 0.7%, Bharti is down about 0.7%. So no major sell-off in any of the stocks, but generally you've seen 0.5% lower initial rates in some of the large caps. Larsen & Toubro also part of that list, and that's why the Nifty is down just about 9 points. On the way up, Coal India has gained further. Margins look quite strong for Coal India, 0.7% higher. State Bank of India, which was one of the top picks from our experts, has actually opened with about 1% gain. So that really has to be, in fact, that's the top gainer now, State Bank of India, 1% higher on that. And that's negated Nifty's losses. 53.83 is what we have on the index now. A couple of other winners would include momentum plays like Sesa Goa, which is up a bit, and Sun Pharma, which was Mehrboo's top pick, is also up about 0.5%. But on the way down, it still remains Cipla, which is now showing quite a bit of sharp reaction, 3% down on that particular stock now.
It's a divided market, 24 stocks on the way up and 26 stocks on the way down on the Nifty right now. On the mid-cap front, however, Lanco Infra taking top of clouds right now, 4.5% up. Markets liking what they're hearing from the numbers, at least for now. Amara Raja Batteries also came out with earnings just a little while back. That stock trading with heavy volumes, up 5% in trade. Wockhardt, another earnings reaction coming in, stock up 5%, and Punj Lloyd as well has been reiterating, though there has been a margin pressure and EBITDAs are down. Markets are liking the fact that they are increasing their profits in the quarter that has gone by as well. On the other side, on the losing, however, side, we've got a few losers as well. We've got the likes of Cipla, as we mentioned, in the large caps. Suzlon is extending its losses as well. Again, 3% down for Suzlon again today after a massive 7% cut yesterday. Remember, CLSA has cut their target price all the way to 19 rupees this morning. It's still a far way off from the current market price as well. Reliance Media Works down 2.5% after seeing earnings as well. Aurobindo Pharma reported a loss as part of our top 10 list. That stock down 2% as well. So no exaggerated moves unlike yesterday. A lot of stocks are digesting what the earnings have come out, and mostly just earnings. Just check on IFCI as well. It's had a beautiful run over the last month and a half. It's managing to hold on about just about 0.5% positive though. And Sri Renuka Sugars, the last one on the checklist, has to be up about 1.5% after earnings that have surprised the market.
Sasken is up 10% after 12% now after that buyback announcement. So big thumbs up from market on Sasken. And of course, Lanco Infratech, as we expected, the quarter-on-quarter earnings look quite strong, and that stock is up about 6%. Vetri Subramaniam now joins in, Chief Investment Officer at Religare Mutual Fund. Vetri, morning, good to have you. Now, last year when I spoke to you at the height of the pessimism, you did maintain that a large part of India's problems are on account of macro issues, not necessarily global issues. But the rally that we have seen has essentially come because of the global liquidity. So, what's your sense now after the kind of rally that we have seen? Have the markets again, become vulnerable to a bit of a correction going forward, because macro hasn't really improved that much?
Yeah, I think you're sort of right in that summation. The local macro still, I think, remains extremely challenging. I think what has changed quite dramatically is the worry that there could be a disorderly outcome in Europe thanks to the provision of liquidity by the ECB through the LTRO operation. A lot of those sort of fears have been taken out of the marketplace, and I think that has sort of helped risk assets across the world, and that's obviously played a role in India as well. But the local macro still remains a little bit of a challenge. But to really talk in terms of the market being vulnerable or not, I think the right backdrop to look at that is the context of valuations. And if you look at the lows that the market was in December, it was trailing almost about 15-16% cheaper than its long-term average trailing valuation. So we're looking at the past earnings numbers and not at forecasts. And even after this rally, it's essentially come back to about 3 or 4% lower than the long-term average valuations. So valuations from that point of view are not really stretched. So you can't really look at or point to valuations as signaling vulnerability for the markets. But I think clearly the local macro remains a challenge. And the best part of a pure valuation rally has already played out. From here onwards, I think we really need to see an inflection both in domestic growth rates as well as in terms of earnings forecasts for the market to have any legs to go higher. So I think the best part of the rally in that sense has already played out.
But why I asked that question was because at the height of the pessimism last year, it was expected that maybe it's the best time to invest, but in some of the companies which have the best balance sheets. But what has happened is, because of this global liquidity rush, the companies or the stocks that have rallied are the ones that got beaten down the most for right reasons. So, Lanco has doubled, or some of the realty stocks have doubled, not necessarily with an improvement in their balance sheet. So that really was my point. In terms of individual stocks, have they become vulnerable?
Yeah, I mean, I think you hit the nail on the head there again. In fact, what has come to us as a huge surprise is the extent to which some of these balance sheet challenged companies have actually rallied so hard. And in a way, it seems to be a little bit of a replay of the kind of macro liquidity-driven rally that we saw in the early part of 2009, March onwards, 2009. So that has certainly come as a surprise. In fact, while we saw valuations had come down to reasonable levels, we thought a lot of the macro news was bad news was in the price. Our strategy has been largely focused on buying only those companies where we thought the fundamentals were strong, the balance sheets were reasonably strong, cash flows were healthy, because it's our opinion that these are the companies which will eventually come out of these entire challenged macroeconomic conditions on a much stronger wicket. So the extent to which companies with vulnerable balance sheets have rallied so strongly has certainly come as a surprise to us, and I would be doubly wary of these companies at the current level, because I think unless there is a fundamental addressing of their problems which has caused them to run up what I believe are unsustainable debt equity ratios when you look at them on a market cap implied basis, really it's very hard to believe that these can be going concerns at current valuations. So we would certainly take money off the table as far as some of these companies with balance sheet problems are concerned.
Vetri, what did you make of the SBI numbers? Even if you don't want to comment on individual stock, but what did you make of the numbers? Because the market has, after a day's rest, reacted quite positively. Do you think the worst of the asset quality issues for PSU banks is over, and the market has factored that in going forward?
No, I think as far as the banking sector and the issue of NPAs is concerned, we still remain quite concerned about how this credit cycle plays out. If you actually look at it so far, there's been a significant increase in the level of non-performing loans within the banks. A lot of this has been driven by the small and medium enterprise exposure that the banks have. It has started to spread into the corporate sector as well. But interestingly, most banks are telling us that they still don't have problem exposures on the infrastructure side, and I find that a little hard to believe, simply given the fact that many of these companies are now experiencing significant execution related delays. What is possible is that perhaps some of these companies don't yet have repayment obligations, and which is why the loans have not yet fallen into the non-performing category, but I think it's only a matter of time. So as far as the credit cost cycle is concerned, we still remain pretty cautious. I think the only point that I would make over there is that we're now seeing a little bit of, I would say almost three sets of players within the banking sector. One is the banks which have really not had too many issues on the credit side, and if you look at some of those banks, they are actually trading 5% or maybe even closing trade close to their 52-week highs at this point of time. Then there's another set of banks which are still quite challenged as far as their credit cycle are concerned, credit costs are concerned, and these stocks are still trading 40%, 50% below the peak prices that they had registered any time in the last year and a half. So I think the dichotomy of what is happening on credit quality has started to play out in terms of the stocks that have done well and the stocks that have done poorly. I do believe the credit cycle remains a cause for concern. There may be some banks where they have the ability to absorb the non-performing loans, and in some cases the valuations came down to a significant discount to book value in November and December. So some of them did look interesting in terms of buying them for a little bit of value. But I think a lot of that has now run the course. And as far as the credit cycle is concerned, as I said, we still think there are challenges on the corporate side. And as far as the infrastructure side is concerned, I think that is still to make its way through the books. What we've seen so far is really more on the SME side and just a few select corporates. So I think I would still be quite cautious on that front.
Vetri, let's talk about liquidity, because while from FIIs we have seen quite a bit of inflow of money, from the domestic side, DIIs have been on the sell side for best part of this rally. In your own mutual funds, what kind of flows are you seeing? Are you seeing redemption pressure with the kind of rally that we have seen, people wanting to book profits? or have you actually seen some money now coming in backed by that momentum?
It's a bit of a mixed picture really, because I think one of the things that has worked well for the mutual fund industry in recent times is the pipeline of money that's coming through SIPs has increased over time. So there is obviously some steady inflows that we always see, but we've also seen a lot of large ticket money tend to get redeemed thanks to the sharp movement in stock prices over the last 2 months or so. And at the net level, if you look at the whole DII segment, so to speak, whether it's mutual funds or insurance companies, the data for this is publicly available, as you're well aware. There's not too much money coming in from the local investor into either insurance companies or into the mutual funds. And I think the reasons for that are not very hard to understand. When you've got bank deposits which are giving you 10% return, when you've got Government of India through its various entities issuing tax-free bonds which give the holder effectively 12% post-tax, then the attraction for investing in equities is frankly quite low from domestic investors. So I think as long as the current rates prevail and as long as debt can give people double-digit post-tax returns, it's very difficult for equity markets to really attract money from local investors. And no doubt, equity investors are also a bit, disenchanted. They've lost a bit of patience, because when you look back at the returns that they've earned over the last 4 or 5 years, it's nothing really great to write home about in terms of the expectations that they might have had from the asset class. Now, that may be the normal cyclicality of market returns, but the fact remains that they are a little bit disenchanted. And when you've got these alternate products which are offering them such high returns, I think it will continue to be a bit of a challenge for the insurance industry or for the mutual fund industry to really attract money into equities.
Vetri, it will be fair to assume that a large part of retail investors would have missed the first half of this rally, or would have missed the January rally, because that normally is what happens in markets after a big bear market. Going forward, what should be the portfolio stance if someone has to come in now and make a portfolio? What do you think is going to be a best portfolio position from this point on?
Well, I think the case to really add into your allocations to equity on an aggressive basis in terms of shifting your overall portfolio allocation is very strong when valuations are at a significant discount to long-term average. But in all honesty, that opportunity was at its most attractive in November and December when, as history always tells you, the headline news was extremely negative. So I think at this point of time, with valuations having come back to sort of normal, there's no case to really take money off the table very aggressively, but you should just continue with systematic investments. I think really the case to make a allocation away from equity would come only if you're trading 15-20% above long-term average valuations. We are nowhere near that, and the case to really increase allocations dramatically would also be when you're at about 15-18% discount to long-term average valuations. We had that scenario in November and December of 2011, and we had the other scenario, mind you, in November 2010 when valuations were almost 20% higher than average. Right now you're trading close to average, so there's really no strong case to be made to move around your portfolio allocations dramatically, but certainly you should continue with systematic investments.
Vetri, let's talk about a couple of sectors and the kind of move that we have seen, a bit of dichotomy coming in. Let's start with the auto space, where last year it was all about two-wheelers, which did well in a bear market, made lifetime highs, and four-wheelers and CV makers were facing pressure. This time around, the trade seems to have reversed a bit with the likes of Tata Motors and a couple of other CV makers, and some of the four-wheelers doing well compared to two-wheelers. Do you think this trend would continue for some more time?
Well, I think right now, what's driving this trade is essentially the fact that the four-wheelers, the cars, and the commercial vehicles, all of that are seen as a lot more economy sensitive. They are seen as a lot more interest rate sensitive. So to the extent that there is currently an assumption that we have reached the peak in terms of interest rates, and that the RBI will cut rates during the course of this year, these companies and their businesses are more likely to benefit from an easing in rates than the two-wheelers, which are typically not so affected by the increase in rates and therefore correspondingly are unlikely to benefit significantly from an easing either. So I think that's really the sort of transition. Also, I think the valuation gap had opened up quite a bit in favor of the four-wheeler pack, where I think valuations had come down quite dramatically and they were trading at a significant discount to the two-wheeler pack. I think we would, sort of largely stay with that trade as of now, but we are pretty selective in terms of the companies that we would really want to buy within the sector.
The other sector which I wanted to talk, Vetri, is telecom and what's happening over there. Just when it looked like they have put the worst of regulatory issues and competition issues behind them, we again had some of these issues coming back. And again, a stock like Bharat